All right, I asked the Discord and we were like, yo, let's just do the freaking boot camp video while on Zoom too. Okay, so today's video is going to be on stop losses. And the reason why we have our current or our previous trade that we took today that got stopped out up is because we're going to use this as our first example of like just stop loss placement. But first of all, we're going to start off and just like move away from this for now. And we're going to, or give me 1 second. And we are going to talk about just like where to put stop losses in general. And then like kind of, I don't know, like where to put stop losses in general. And then also overall, like, I'm spacing out. Sorry. Today, we're doing a video on stop losses. Okay, so to start off, the most basic and the most like fundamental thing in terms of stop losses, I rarely like do like kind of a elongated stop loss. Okay, and the only times that I'll do that, we'll talk about that later. But most of the time, when people have a stop loss, they'll see, okay, liquidity sweep, break of structure, and then like order block entry, and then boom, they're in, right? Let's say it's a short position. They will typically almost always put their stop loss above the liquidity sweep, myself included. Okay, I almost always put my stop loss above the liquidity sweep. Okay, and I do this because if our bias was correct, if liquidity was actually taken out, then price has no reason to come back above this high, right? Because this is where, right, our order block. This is where orders were filled, and the price point above this high, and we'll talk about why we put our stop loss slightly above the highs as well to cover for spread. But if price ends up coming back above this high, then that means the liquidity sweep was not valid. That means liquidity was not swept. That means there was not enough volume or volatility. That means there weren't enough orders to be filled to push price in our bias and in our direction. So our stop loss always has a purpose. Our stop loss is essentially our invalidation area. Okay, so if price ends up coming back up here, then cool. Okay, that means our trade is invalidated and that liquidity sweep, whatever we were taking the trade based off of, that area, that price point, that price range, that confluence, that building block was not valid. We were wrong. Okay? So that's standard, okay? That's like the most basic thing. I almost always put my stop loss above the liquidity sweep. Okay, so oops. Boom. That's as simple as it gets. Okay? That's like, you're just like super simple, perfect fucking like easiest way to do it. Stop loss above your liquidity sweep. Whether you're entering off of a fair value gap or an order block, your stop loss should still be above the liquidity sweep. It should not be right above this high, right? Let's say you enter off of like this and it should not be right above this high. Why? Because price could easily come back a little bit higher and then come back down. Okay, you want price to be above the liquidity sweep because that's where price would be invalidated for us. Cool? Cool. Okay. Moving forward, what are some exceptions? Delete this. Some exceptions to this. And I don't even really like these exceptions. If price looks like this, and this is our breakup structure, and the liquidity sweep is so high up that it pretty much would give you a terrible risk to reward, then I try and find other confluences within here. Like, okay, let's say there's a fair value gap here, an order block, or like order block like right here. I would put my stop like above the order block, and I wouldn't put it above the liquidity sweep. Does that make sense? Because we want our ideal trade is a good risk to reward. right? But the reason why I don't necessarily like doing that is because, right, the invalidation point is above the liquidity sweep. So price could still technically move up and take you out of the trade and still go within our bias. Okay, so that's the easiest thing to do. Just put it, boom, below or above the liquidity sweep. Now let's look at the trade that we took today and go over how price is still technically within our bias. And look at this right now. Like, we would still be in profit. We would be in profit right now. But that's nothing to cry about. It just means our bias was correct. Good job, us. But anyways, if we're seeing this right now and we see, okay, this is where our stop loss was. What were our confluences? Go look at the trade recap. I don't want to go over it again. But we entered off of this break of structure, off of this candle closure. Okay? We put our stop loss, first of all, every single time, at least put it like, I would like to say like 0.5 points, 0.5 points below the actual price point, or figure out what your spread is on your broker for the specific pair. Because if you put your stop loss directly on this price, like literally on this exact price on your brokerage, guess what? When price comes down to like right here, you will be stopped out of the trade. Why? Because the ask price is right here and the bid price is right here. Or I don't know what the difference, I don't know which one's higher, which one's lower, ask or bid. But you know what I mean. Bid or ask price, right? You are going to get stopped out by spread. And you're going to be screaming and fucking crying if price ends up coming back up and going in your direction. So what do you have to do? You have to account for spread, because guess what? Even if price comes to this exact price point, your stop loss is going to be under here and you're going to be protected, because it's only invalidated. Your trade is only invalidated once this price point gets broken below. Okay, so what I always like to do, I like to give it like a little bit of room. So for us, ours was like, what was it? It was four below. So it was like right here. As you can see, we got stopped out by this. Okay, and that was for, some other reasons. Maybe we should have covered ourselves by putting price lower over here. I put my stop loss underneath here because we had a liquidity sweep on the 5-minute right here, and then a break of structure on the 1-minute to the upside. So I was considering this my liquidity sweep. So that's why I put our stop loss right here. Does that make sense? Okay. What are some of our exceptions for, maybe when we don't have a liquidity sweep, or maybe it's like a higher time frame trade, such as this one. Okay, and look at this price. And we're on Zoom right now with my Discord. I know they're raging because we had a 5-minute break of structure right now. But hey, that just proves our bias was correct. Okay, so I know y'all are raging. I don't even have the Discord open, but I know you guys are raging. Some exceptions, right? Like for this example, okay, we had a liquidity sweep on the 15-minute, break of structure to the upside on the 15-minute. Could we have done a long-term trade on the 15-minute? Sure, but no one wants to have this all the way down here and have to make this, which would have been our final take profit, our first take profit, for a way lower risk to reward ratio. Okay, so what can you do on that? Well, you could scale into a relatively higher time frame, okay, and try and find, maybe a low, like one scale lower low that's underneath the liquidity sweep if you want to be extra safe. And again, you need to keep risk management in mind. You need to keep risk management in mind with this. All of this is just purely based off of your own risk tolerance. That's what I like to say. whatever you are comfortable risking, because I use a set lot size, and we'll cover that in this boot camp, how you can figure out what your set lot size should be, and then how you can find the scale of different lot sizes to use based on your confidence for the day. So like for today, for example, we won't get too deep into this, but today, for example, I risked half of my usual lot size. Usually on the S&P, my normal is like 100 lots, and I know you're going to say, damn, that's fucking crazy. It's 10 units per lot instead of 100 units per lot size, which is what most brokers are. So just, it really would be essentially 20 lots on like a normal offshore brokerage. Hanko's just a little bit weird. Okay, so my usual is 200. I risked 100 lots today. Because why? We had high impact news, and we also have a bank holiday tomorrow. So odds are we were going to have relatively low volatility, kind of choppy market conditions, and we also had high impact news. We have high impact news throughout this entire week. I'll probably de-risk myself this entire week. Okay, that's something to keep in mind. So it's like your stop loss is purely based off of your risk tolerance. And then also understanding where is your invalidation point. That's all it is. Your stop loss should never be like, shouldn't be based purely off of points or pips. It should be based off of where price is then invalidated, where your bias is invalidated at that point. Okay, so for me, my bias was invalidated today because I saw we had a sweep of liquidity and a break of structure to the upside. My stop was underneath this liquidity sweep. Yes, my overall daily bias was bullish, right? And that is getting fulfilled. But for this specific execution, for this specific trade, I was considering this a liquidity sweep and a 1 minute break of structure. Does that make sense? So this was my invalidation point. It got invalidated, but then price ended up moving higher. Make sense? Cool. All right. That stop loss is explained. Okay, so that's going to cover it for today's video. I know it was relatively short, but find your invalidation point, understand your risk tolerance, and you'll be good. Okay, I think tomorrow's video will cover set lot sizes and kind of start talking about that shit. And then we'll also talk about just like how we'll talk about different ways to calculate your lot size and different ways to calculate your risk. We're now starting to get into like the smaller things. So this is getting fun. I look forward to seeing you boys tomorrow. Don't fucking trade tomorrow. Don't fucking trade. If you trade, you're literally stupid. It's a bank holiday. Don't trade. Okay, don't trade, please. And don't trade some random foreign exchange pair. Okay, the US bank holidays typically slow all the markets. All right. So Discord, I know you're raging because we barely got fucking wicked out, and this shit's probably going to hit, if we're being real, all of our take profits. But it's okay. It's something to learn from. Okay, cool. I'll catch you boys tomorrow in Discord. I'm going to end the Zoom right after we end this. All right, peace out.